really talking about today are basically terms that you ought to know as when you're talking to brokers, when you're talking to banks, when you're talking to other things. And we started last week with some of the common formulas for analyzing deals. And I'm just kind of run through these. So if you are not familiar with some of these, I suggest you go kind of look at the recording that we put up last week. So this week we're going to just start with a couple of these are kind of terms that we use a lot when we're talking to brokers and other multifamily commercial investors. And I just want to go through and tell you quickly what they are. We did LOI stands for letter of intent. And we had a teaching Tuesday about that, what, 3 or 4 weeks ago. But it is basically, in commercial real estate, we don't really do a go straight to contract like you do in residential. We do basically a letter to the seller, to the broker, telling them what we are interested in buying, and it is non-binding. And so it's a lot of us think of it as a way to start negotiations. And it's so is LOI, you're going to hear it, it's just a letter of intent, and it's our first bid to a seller, to the broker, that we are interested in the property and what we think we might want to pay for it in terms. All right. Trailing 12. So every month when you are doing your books, you're going to do an income and expense statement, which is down there further. It's an I&E, right? And a trailing 12 just means that you are getting the last 12 months in order of your income and expense statements. So if I was putting in a looking to buy something now in the middle of April, then I would expect to see the income and expense statements for March, February, January, December, and on back for 12 months. So it is not a year, it's 12 months. It's the most recent 12 months of what the property's been doing. And we typically want to see 12 months of operation so we can kind of get a sense of how it's been doing. Classically, there are ups and downs, sometimes seasonal, sometimes insurance comes at some times of the year, taxes at another. You have more vacancies at certain times, you have more costs at certain months of the year. So you just want to get a sense over the last 12 months what the property's been doing. Okay. Trading for means it's a term that we use to sort of say what are properties in the area selling for. And you are going to hear people tell you a couple of things. They're either going to tell you a cap rate, or they're going to tell you what something is selling for per door, meaning per unit. And so when you ask somebody, what are things trading for in the area, you're asking them to tell you either the cost per door or the cap rates, those kinds of things. All right. Dial in. That's a term we typically use when we are talking about the when we're looking to see what the cost may be to rehab or fix something up. And so if I'm talking to a broker, I will sort of say, what do I need to dial in to fix things up, to get some of whatever needs to be done? And they're typically going to tell me on a per unit basis. That doesn't mean it only includes what needs to be done in the units. It's also going to include what needs to be done in common areas, in roofs and landscaping, but it is calculated on a per unit basis, so to speak. And so we just say, how much do I need to dial in for improvements, and what are they? All right. P&L is the profit and loss, and it is different than an income and expense statement, although they are similar. A profit and loss is one of the three classic reports that you get in financial books. Profit and loss, statement of cash flow. Oh gosh, what's the other one? I'm just having an Alzheimer's moment here. Balance sheet. And profit and loss is going to include typically the mortgage and interest within your numbers, whereas an income and expense statement pulls things more so you can more easily see the net operating income. And so an income and expense statement is typically going to be all of the income from all sources, all of the expenses, and then below that, you're going to have the net operating income, the NOI. And below that, you're typically going to have the mortgage and the interest on the mortgage. And below that, you are typically going to have a CapEx or reserves that, and then you have a cash flow after CapEx, after reserves, right? So they have a lot of the same information. They are presented differently. And an INE is more commonly used in real estate so that we can see more easily what the net operating income is, because that's how we tend to value. Okay, product just is, I don't know where that really came from, but it really means that we are the type of property you're buying. So the product is an apartment building, it's a warehouse, it's a retail space, it's a combined space, right? Repositioning is the word we use in commercial for rehabbing, right? So when I am repositioning a property in commercial, I'm typically talking about rehabbing. But unlike residential, repositioning can also mean that I'm trying to change the tenant base. So in multifamily, when we're repositioning, we need to get clear, are we talking about fixing up the units and the property? Are we talking about getting a different type of client in? We're repositioning the tenants, or are we talking a little bit of both? And so most of the time you're going to find that it relates to rehabbing something, fixing it up, but not always. And CapEx it's basically the reserves. It's what we have in reserves. It's below the line. It's how much we put aside for upgrading the property, etc. And RUBS it's a ratio utility billing system. It is fairly common in properties, particularly older properties, where you don't have the utilities individually billed. When you don't have individual meters for water, for electric, etc. And so a ratio of utility billing is basically you have some way of dividing the utility bills up among your customers based on some sort of criteria, and those criteria vary. The common criteria that people use are the number of residents in a unit, Sometimes you'll see it's just by the number of units. But it's a way of divvying up utility bills and billing them back to the residents to get that expense basically neutralized most of the time. So it's a lot of people do. It's one of a lot of people's, including mine, favorite way of increasing the value of a property. All right, so the next bunch of the next term. So do I have any questions about this?
Not in chat.
Pardon?
I was gonna say not in chats, no questions written out in
Okay.
chat.
If anybody, then we're going to move on. Now, these are terms that you see more often in financing with banks, with other kinds of financial kinds of things. And I am going to just kind of quickly go through what some of these are. So depreciation is basically, it's an accounting method that is used to allocate the cost of an asset or your property over its useful life. All right. And it attempts to book how much of the value of that property has been used over time. Whoa, I'm sorry, folks. When we get down to cost segregation, we're going to talk about this a little bit more. There are lots of different types of depreciation, including straight line depreciation and various forms of accelerated depreciation. And a cost segregation is a type of accelerated depreciation, right? I don't know what I'm doing here, but I'm sorry. All right, so a passive loss. It is basically a financial loss within an investment or trade, but it is limited to people who are investors who are not a material participant. So that tends to mean passive investors. If you and I form a company together to buy a property and we are the managing team, we cannot take a passive loss. Passive loss is limited to passive investors. And it is used when they experience a financial loss. They can come from a variety of activities, including equipment leasing, rental properties, limited partnerships, etc. So they're not limited to a type of company. They are limited to the type of the investor. On the other hand, those of us who are active in a deal, we are considered material participants, and our losses are going to show up differently, right? And a taxpayer can write off passive losses against passive gains. So it's a way to decrease tax bills. So 1031 exchange. You can, most often they're real estate investments. And it allows capital gain taxes to be deferred, not forgiven. So they are moved. So if you were to buy a property for $1 million and sell it for 3, 10 years down the line, then the difference between what you bought it for and what you sold it for is what you're going to be looking at capital gains. And so that can be a lot of taxes if you're going to, if you all of a sudden get $2 million in your pocket, right? So what a 1031 exchange does is it takes all of that $2 million and you never put your hot little hands on it. And it goes to a company that does 1031 exchanges. And they hold that money until you find another property that is of greater value. It has to be of greater value. And then that money goes into that. And now your capital gains is attached to that property. And so it is just deferred. All right. It can only, a 1031 exchange can only be done with like properties, like kind properties. So you can't 1031 exchange from a apartment building into a gold mine. You could go from an apartment building to a larger apartment building. You could go from an apartment building to a warehouse. They're all real estate. And so it's like kind. Okay. It is a big tax break. And it is especially a tax break because if you hold something, if you keep passing that gain on, then once you or whoever's holding that real estate passes away, your heirs can recalibrate the value and it resets the basis. But what I do want you to understand is that you're still carrying that gain and that tax burden from one property to another. So you have to be careful when you're doing this because it can come back and bite you. I think they're great, right? So I think that's what I want to talk to you about that now. Cost segregation. Cost segregation is it's a tax planning strategy, actually. You cannot do cost segregation on your own home. It has to be on some kind of other property. But basically, when you are looking at a property, you can break that property into various pieces. So if you think about it, how often you would have to replace refrigerators and stoves is going to be more often than you have to replace roofs, which is more often than you would have to replace a building itself. And so what cost segregation does is it basically breaks these components of your property into pieces, puts a value on those pieces, and then lets you accelerate the depreciation for some of those pieces a lot faster. It is a tax deferral strategy that front loads the depreciation. So we talked earlier about straight line depreciation and tax deferred kind of depreciation kinds of things. So a 1031 exchange is something where you're breaking these apart. And you can get some really pretty significant tax breaks in the early part of what you are doing. So typically, you're going to break things into personal property. You are going to break things into things that are, so that's like furniture, fixtures, carpeting, window treatments, etc. And then the other group is called land improvements, which includes the elements from the foundation, sidewalks, landscaping. The things in between, like roofs and HVACs and things like that, are an intermediary. So the personal property, you can depreciate between 5 and 7 years, roofs and things like that, around 15. And some of the others are going to be 25, something like that. But if you did a straight line depreciation in commercial real estate, you're looking at 39 years, which, so this beats that, right? It is typically done either when you are getting an appraisal on your property, you get somebody who can do a cost segregation study, or very soon after you have bought it. So you can capture a lot of that depreciation. It costs money. So if you can also do a cost segregation study on a single family house that you may buy, but it needs to be in the $250,000-$300,000 range, I would think, before it makes a lot of tax sense. But I have personally saved myself, with one property, $100,000 in taxes by doing a cost segregation study. So not to be sneezed at all. And if you are buying small multis or properties that cost a little more, this should be something that is routinely in your armament just to save yourself some taxes, which is your single biggest expense. Okay. So I'm not going to talk too much about entity selection here, because I'm going to do a Teaching Tuesday on this down the road here.
Hey, Nichole.
But let me say that just in saying that 90 to 95% of the time, you want to use LLC, limited liability companies. It is rare when a C Corp or an S Corp is the best decision. And we'll talk about those a little bit later, but just when in doubt, LLC is the answer.
Nichole.
So, yes.
So I missed you on the 1031. Vina was asking, can you 1031?
I'm sorry?
Vina was asking, can you 1031 from a triplex to a 10 unit, since only the 10 unit is technically classified as commercial?
Yes, you can. Real estate is real estate. So it doesn't matter if it's single family to a multifamily, over to a warehouse or to a retail building. What you can't 1031 exchange is your personal residence. And if you are living in one unit of 4, I don't know. That's a little bit beyond whether I would want to comment on that, but I think you would want to get a reading on that, if you can do that. But for sure, you can go from single family to multi, and that's how, in fact, a lot of people jump their wealth. They go from one property and use that money from a cap that would have been, that would have been their profit when they sell it, and put it into another property. Okay, so asset protections. We'll do something a little bit more on an asset protection too, but the reason we use entities is to protect, most of the time, us personally from being sued, right? So if you have a rental property and you own it in your own name, that if somebody trips and falls, they're coming after you as the person. Whereas if you own a rental property and have it in some kind of an asset protection, like an LLC or something else, then it is the LLC that is going to be sued. So the reason we do asset protection is generally to try and prevent external people from coming and getting us. But the truth is that most of the time, the reason these LLCs or other kinds of assets that are in other kinds of entities are broken is because of what we do or don't do internally, what we ourselves do. So we don't take the rules seriously, all right? One of those rules that I just heard of is, well, no, I've heard of the rule, but I just heard of somebody who hasn't been doing this, is that if you have an entity and that entity does not have its own separate bank account, most courts are going to say it's not a real entity. And so that does affect us as investors, because we may well have a form an entity and then have a property management company manage the property for us, and they're going to put the money in their account. And we don't have a entity. We don't have a bank account for that entity. And so I'm telling you right now, the one thing that you for sure have to do is, if any of you have entities, is to make sure there is a bank account for that entity, even if it doesn't have a lot of money in it. All right, let's talk for just a minute about land trusts. There, frankly, is a lot of issues, a lot of false information out there about land trusts. Land trusts, and I'm here to tell you, I know what I'm talking about on this. I have heard the gurus say things differently, and they're flat out wrong when they tell you a land trust provides asset protection. It provides no asset protection. What it does do is provide privacy. So people can't really easily find out who owns the property. So I certainly am not not anti-land trusts. I think they have a lot of benefit in times, but the beneficiary of that land trust needs to be an entity. And then you can be, or somebody can be, the beneficiary of that entity. But do not have a person's name as the beneficiary in a land trust. A beneficiary in the land trust can be a personal property trust if it needs to be, but not you as a person. And we'll talk more about that later time. So benefits of time, that's just something that the longer you hold a property, everybody knows that there's inflation. And so what was $2 today is $2.15 next year. And that keeps happening. So one of the benefits of holding things for a time is that as time goes by, the value of a property goes up, rents go up, so do expenses, but at the same time, you're paying down typically the mortgage. And so how much you owe goes down. And because of just the natural inflation, what the property was worth 10 years ago is not what it's worth now. And you've had a significant increase in the value. And so there's a lot of benefits to holding things over time that is just almost magical once you start getting past 10 years. the last thing I want to talk about a little bit is banking leveraged investing. So I think there is a misunderstanding in how we commonly use it versus how banks use it. So most of the time when we talk about using bank leverage, what we're talking about is that we're talking about putting 15 or 20% down on a property and the bank lending us the other 80%, say. And so we're leveraging, we're borrowing the 80%, and that leverages how much our money works for us and therefore increases our cash on cash return. All right. But in banking terms, a leveraged finance investment is a type of banking that provides financing for things that are already highly leveraged, that are speculative grade companies. So it is a special kind of lending for things that already have a lot of debt on them, that are risky, right? And the way you do that, the financing is done by using an above normal, let's just say, amount of debt as opposed to equity or cash to fund the purchase. So we're not putting a lot of cash or equity and other properties into this to fund it, right? The debt instruments are used are typically loans and bonds that are syndicated and underwritten by banks. So they're used for the same way to hopefully increase the return on an investment, but it carries a high debt to equity ratio that we typically can't do and probably don't want to do. And so the interest rates are significantly higher. So the only thing I really want you to take out of this is that how we typically use the word using bank to leverage our investments is not what a bank means when it is talking about leveraged investing, bank leveraged investing. And we don't want to be doing what the bank is talking about. So in leveraged investing, right? We don't have the wherewithal to make that work. And so I hope that's kind of what I wanted to terms I kind of wanted to go over now. And I know I've probably taken a fair amount of time. So we're going to take maybe one or two questions here. And then Jane and Sharon are coming right up with a really great presentation from somebody they know. So let me just kind of turn it over to Jane and Sharon for 1 minute to tell people what's coming, and then I'll jump back to questions.
Hey guys, so we're from the Virtual REI Academy, and we have Miss Sandy Pullen coming up, who is a rock star in the property management, among other things. She's also an investor and an agent and a broker and all kinds of stuff. And she's going to talk about Section 8, which is a good way to make guaranteed money instead of depending on market, and any other kind of stuff you want with property management. She's been doing it a while. We've known her a bit, and I'll do a little bit of an introduction when she gets here. But I think she's already on the call, but we'll do a little bit of an introduction and she'll get into a presentation, which we can't wait. And we have our notepad ready. She's a dynamic speaker, and we're certainly glad that she's here with us.
All right, thanks you guys. As you see, I just put up another slide. If you want to see more or learn more about what we actually do and what all is entailed in our classes, you can go to the multifamily webinar. And then I'm just posting up here where you can see the replays of all of the our Teaching Tuesdays. James, what kind of questions do we have?
Nothing in the chat right now, and I'll put the links up there so they're clickable for the webinar and for the YouTube channel.
All right, and so now if anybody has, we've got time for about 10 minutes of questions. So please just open your mics and ask questions if you've got them. Oh,
That's a first, no questions?
I know. Well, I knew this wasn't a really stimulating conversation, but
So I have a question on the asset protection and the land trust. So-
on the land trust, okay?
Yeah. So if I put my property under the land trust and put that under a irrevocable trust or revocable trust, is that
Then
going to protect me or no?
An irrevocable trust is probably, because it's irrevocable and you can't change it, putting an irrevocable trust as the beneficiary works. But that's about the only kind of trust that would work.
How
So
about the revocable
if
trust? Generally,
a revocable trust is not an entity. So you do not put a beneficiary of a land trust as a revocable trust. Irrevocable, yes. Revocable, no. So if you've already done that, you can redo the land trust and have it be an entity in there. And then the revocable trust be the beneficiary of the entity.
okay.
Okay, but you really need an entity, because somebody can come in, you know, if your trustee, you can tell the trustee of a land trust not to discuss who you are, but they get subpoenaed before a judge and the judge says they're going to slap them with a contempt of court. If they don't answer, they're going to answer.
Mhm.
And so all of these gurus out there that are telling you to, you know, to just fire that trustee and hire another one. If you know that you are in trouble because of something and you do that with the knowledge that something may happen, you are in deeper trouble if the courts find it out. So the way we prevent some of that is to just have some type of an entity be the beneficiary of the land trust.
Okay.
There's a lot of benefits to land trusts besides the privacy. And I've actually done a couple of classes that are over in the Virtual Real Estate Academy on land trusts.
Mhm.
That kind of goes into that with a fair amount of depth. And so if you're interested, you can talk to Jane and Sharon and or James about that more. But leave it to say that, you know, there are some really stellar benefits of land trusts, but entity protection isn't one of them.
Mhm. Okay. No,
Okay.
I have to expand on that. You know, I discussed with one of the, I don't know if that's what they said, but they asked me to put, for plural protection, put your accounts also under the entity revocable trust. Like, you know, if I have savings account, if somebody comes after me personally, to prevent even your personal accounts also from the, you know, the liability part of it, you can put them in the trust. Is there a correct strategy, or do they need to be under the entity too?
Okay, I'm not sure I understood that. I'm not sure I
So
understood.
if you
the
have a
question.
personal accounts, this may be out of topic, but I'm just asking, like, if you know, if I have a personal savings account, if somebody
Okay.
sues me on my property.
Okay, so So I'm not sure where we're going with this, and so I'm not, let me see if I can answer, but I'm not sure that I got your question. So let me see if, and if I didn't, please try and say it again. So to me, the best way to prevent issues with a property is insurance. A good basic insurance policy that has good liability coverage. Okay. Because that's going to prevent 90% of things, and you get really good lawyers if you have good liability coverage. Most people who are suing are not going to go beyond the liability coverage of an insurance. What they're really going after is the insurance coverage. Okay. So the way you, if somebody falls and on a property of yours, the property management company is going to get pulled in, and they're likely to be asked who owns the property. If you have, if you own that property in your own name, you are at some level of risk. So a savings account is going to help to a certain extent. A land trust is going to help because it will do some, it'll allow some privacy. But both of them still carry the risk of getting to you personally.
Mm-hmm.
And so the way we get around that is by putting those properties into entities.
Okay.
That are separate. Did that answer your question, or did I miss your
Yeah.
question?
So if the property is put under entity, they cannot personally come after me. That's what you're saying, right?
Most of the time, no, that's correct. But that gets back to that thing that I was talking about, is that you have to make sure you follow the rules of what you have to do to make sure that that entity is separate from you. And that includes a separate bank account. It includes that you don't take money personally from that account, that you don't mix accounts, that you keep minutes once a year, that you have a meeting once a year, that you have your paperwork together, right?
Yeah.
And so as long as you do that, then it's pretty hard to break the LLC.
Okay.
All right, how are we doing with time? Well, let's take one or two more questions, and then we are going to turn it over. Nobody else has questions?
I guess it doesn't really even have to be about terms, right? It can be anything about multifamily.
Yeah, it sure can. Well, I don't want to force anybody, so thank you, everybody, for being on. I'm trying to
Sorry,
remember.
I do have a question.
Vina.
Yes, I'm sorry. I was really happy to log into your trainings because I was studying this information and I noticed that a lot of people only included down payment and not all of your costs, all of your acquisition costs when they were calculating the cash on cash return. So can you just speak to that a little bit? Because I was trying to figure out what the industry standard is, because all of your costs on the front end, that's all a sunken cost, but all the calculations that I see, they only include the down payment.
Yeah, that's typically what brokers do, commercial brokers. When they tell you what your cash on cash return is, they are just going to include the down payment. And in fact, they only use the down payment when they tell you what cap rate you're buying it at. But the truth of the matter is your capitalization rate is if you're looking at what the return on your investment is going to be, it is going to include all of your acquisition costs. And so if somebody tells you you're buying something at a 5.5 cap rate, and you add all of these costs here that are on this slide, which are not atypical in any kind of deal, then your actual cap rate that you're buying it is lower. And therefore your cash on cash return is going to be lower. It's going to take you longer to get anywhere, which is why I always tell people before you go in to do a deal, you really need to know what your total acquisition costs are and use that to figure out your returns on your investment, both in cash flow and on refinance or sale, to figure out what your actual annualized return is. So to answer your question, here is what I think typically goes into acquisition costs. All right, so so you're going to have whatever your down payment is. You're going to have the closing costs, which are typically 3 to 5%. And those include your third-party reports. It includes your your attorney fees. It includes proration taxes, insurance, all those kinds of things. It's going to include, if you're getting a loan from a lender, they're going to have a loan. They're just typically going to have a point to underwrite your deal, right? You are going to have to bring in money for reserves, for CapEx, for setting up accounts. You're going to have acquisition fees that if whoever's setting up the deal, if they get some money for putting it together, all of that kind of goes into this. And so the reason I separated out the loan points from the bank fees is because you typically can't negotiate the loan fee, the loan points for underwriting, but you can sure negotiate those fees, all those other fees that lenders put on top of them, put on top of that. You're not going to get rid of some of them, but you should be able to get rid of some of them. Did that answer your question, Vina?
Yes, it does. Thank you so much. I appreciate it.
Yep,
Hey, Nichole, I had one other question.
please.
So you were talking about last week or a couple of weeks ago about the foreclosures that are going to be coming in multifamily. So like we're pretty proficient at finding single family foreclosures. What's different about it? How do you find them? And is LoopNet a good place to locate those?
Okay. Can you say that again for just a second? I'm sorry, I lost concentration. I apologize.
No,
Something
no
was
worries.
falling over here.
No worries. Just you said foreclosures were going to be coming to multifamily because everybody bought wrong. We're pretty proficient with single family. How do we find multifamily foreclosures? Is that just through a broker or LoopNet, or is there a special site that you can find foreclosures in the multifamily space?
You can find them. A lot of times, frankly, if the smaller banks, particularly, will have a list of their bank-owned properties. And if you get to know somebody there, a lot of times they'll just give you that list and they can send it to you monthly. But the things that's different is that a lot of times banks will negotiate with you to sell you the note. They're much more likely to sell a note on a property. They're also, I think that where you're really going to find it is that they're going, because people paid way too much for these properties. I mean, so I think that, you know, that they're going to be open, if you talk about notes, to actually short selling those notes. But that is more of a bank to you kind of discussion. The person who owns it doesn't get involved quite as much. Brokers are going to, when people start getting into trouble, they are going to try and list the properties with brokers. I actually don't know if there is a list that you can buy about multifamilies that are 30, 60, 90 days late. So pre-foreclosures. I'm just really not sure about that. Most of the time when I've been doing this, I've been working with banks directly on these kinds of things. And so if I have loans with banks and I've gotten to know them, I'll just ask them if they have any bank-owned properties, and could I see their list? I might be interested in buying some, and you can negotiate with those. Now, you're not going to have luck, obviously, with the Banks of America and those kinds of things, but savings and loans and small regional banks, smaller banks. I generally haven't had any trouble getting those lists. Did that answer that, Jane?
It sure did. Thank you.
All right.
In the
At
last,
this point, James, have we got any other questions?
yeah, actually, in the last 2 minutes, I don't know if everybody knows what a note is.
What?
I don't know if everybody knows what a note is.
Oh, okay. A note is basically when you have a property, you have the deed to the property, you have the mortgage, and you have the note. And the note is what says how much you owe and how you're going to pay it back. And the mortgage ties the note to the property. And so instead of foreclosing on the property and getting the deed back, the banks will frequently sell the mortgage and the note attached to the mortgage at a lesser price if somebody isn't paying. So it's called a non-performing note, and you can buy them at a discount. Did that answer? Is that clear, James?
I mean, it is to me. If anybody else has a question, please, let us know.
All right, well then let me get out of, I'm going to stop sharing, and I'm going to turn this over to you, back to you, James, and over to